Risk tolerance. So today's class is all about understanding the client's risk tolerance. This can be done at different points during your sales presentation process. It can be done at the end of the fact finder. It can be done mid-presentation with the client. There's a lot of leeway up to you to determine where you and your client are in the process. Usually I pull out this risk tolerance questionnaire after doing the majority of the fact finding and understanding that the client is going to have some need, and I've opened up some opportunity for me to be able to help them manage some money. Once I've determined that, I'm going to pull out this risk tolerance questionnaire, and after they've already expressed interest in giving me an opportunity to manage their money, or at least take a look at what they currently have, I want a baseline of knowing how conservative, moderate, or aggressive they are as an investor, along with their time horizon. That's probably already been expressed to me during the fact finder on when they want to retire, but I want a very clear picture of what everything looks like. And so this risk tolerance questionnaire is 8 questions. It takes about 5 minutes to go over with your clients. The first 2 questions are going to be on time horizon, and the last 6 are all about risk tolerance. So I'm just going to go through it with you guys, read these questions aloud, and have you guys have this piece of paper pulled up also. So if you don't already, pause this video, ask me for this risk tolerance questionnaire, or you can Google it. It's online. It's just a standard risk tolerance questionnaire that almost all investment places ask. Now, as non-fiduciaries, you may not have to dive deep into the weeds on this risk tolerance, but I feel it's always helpful to know my client a little bit better. And if I do securities products, I want this done so that it's a CYA type of deal for me to go back on and say, based on the client's risk tolerance, this is how I came up with all of my decisions on recommending investments for them. So that's kind of the quick topic. So going over these questions here, the first 2 questions are real simple, and we just answer them straight up. I'll sometimes read the question. I'll sometimes have the client read the question. It's all about how comfortable you feel they are going to be on answering all of these questions and going through it. Sometimes you can have 2 or 3 of these printed out, and you can sometimes split answers between the clients. So know that if there is husband and wife that you're meeting with, if one says A and the other says E, you can split the difference and be C, or you can split up their investments differently and follow their risk tolerance per individual if you'd like to. So there's a lot of wiggle room here in understanding what is best for the clients overall and individually. So real quick, the first 2 questions. First one is, when do you begin expecting withdrawing money from your investment account? So when do you begin expecting withdrawals from your money in these investment accounts? And that's usually all about how long until retirement, and then do you need money right away, or could you wait a while because your income is exceeding your expenses, so you might not need this right away. And so it's getting them to answer that question. And then the second question, once you begin withdrawing money, how long do you want it to last? For a lot of folks, especially the ones that have a lot of money, they're probably going to want that to last forever. So it's okay to just mark the aggressive side of that nature here. Now, I want you to understand we've segmented this time horizon very differently from the risk aversion score. So now that I understand their time horizon and we've scored that up, we can look at our back sheet and figure out kind of what that equates to for these folks. I don't want you to pay too much attention to the time horizon at the moment, because the risk tolerance is really where we're drilling down on. So question 3, which of these choices best reflects your attitude towards inflation and risk? Main goal is to avoid loss. Main goal is to earn slightly more than inflation. Main goal is to increase portfolio's value. Main goal is to maximize portfolio's value, and they're willing to take on more risk to do that. And so out of those, obviously A is the most conservative, obviously D is the most aggressive on that one, and we just take that score and we run with it. So the last page here, there's a couple last questions on risk aversion, and it says, question 4 and question 7 I'm going to lump together here. It's real easy. We're talking about a $10,000 investment over a 1-year period of time, and these are the different portfolios that you have access to. So on question 4, portfolio A is going to be the most conservative. Your potential best case is the lowest there, the probable result is the lowest there, and the potential worst case is the highest value, so they're risking the least amount of money. Portfolio E is the opposite. It is the most aggressive. The potential best case result is the highest dollar amount, the probable result is the highest dollar amount, and the potential worst case is the lowest dollar amount, so they're taking on the most extreme levels of risk there. Question 7 is exactly the same, but now we're talking about it on a percentage basis. If you track these, the percentages in dollars are actually pretty close, so we're going to skip that for point of this video, but definitely go over that in depth with clients. Question 5, it says investing involves trade-offs between risk and return. Which statement best describes your investment goals? Protect the value of your account, keep risk to a minimum, focus on long-term investment results, or maximize those long-term investment results, and you're willing to take on a little extra risk to do that. So we'll score that one up. Question 6, historically markets have experienced downturns both short and long, followed by market recoveries. Suppose you owned a well-diversified portfolio that fell by 20% consistent with the market. Assuming you still have 10 years before taking withdrawals, how would you react? You got to remember the client may not be taking 10 years, but you still want to see what they would choose in this example. Would they change to be more aggressive? Would they not change their portfolio? Would they wait a while before changing? Or would they change to be more conservative? Get the answer out of that. And then question 8 is a pretty good indicator of where they are overall. Still want the score out of this though. It says, I'm comfortable with investments that may frequently experience large declines in value if there's potential for higher returns. Strongly disagree, disagree, or agree are the only 3 options on there. So we score that up. So go ahead and maybe fill that out for yourself so you have some scores so that you can understand where we are on the process here. And then I'm going to go over how we calculate all of that as well. I know you just score it and add it up, but more so than that, I want you to understand, just from taking time horizon out of this just for a quick second, the risk aversion score is usually appropriate to understand how much money they should have in equities and stocks and mutual funds that have large exposure to the market versus how much exposure they should have to cash and fixed instruments and bonds and treasury bills and stuff of that nature. So going through this risk aversion score, if they're close to 100, they should have a large majority of their portfolio in more aggressive options. If they have a risk tolerance or risk aversion score that is closer to 0, they're going to be more conservative and they should have very little access or portfolio designed to be specifically in those equities. So kind of knowing that and understanding where they sit on a risk aversion score is very helpful. Now we take into account the time horizon. So based on them being super aggressive, but they also want to retire here in a couple of years, okay, so now we taper it down a little bit and say, well, because we're going to need some liquid money, what we're going to want to do is make sure not all of this is in stocks, because if the stocks, this now goes back to distribution strategy. If the stocks crash and you need to take money out, we're not putting them in a good situation, so we need some of that on the sideline. So with all of that said, I want to focus this risk tolerance to be all about annuities. If we have someone that has a score of 0 to 50 on this risk aversion score, I can have in my mind, now you got to keep in mind all of the other things that we're talking about here with liquidity and tax harvesting and distribution strategy and the client's time horizon for all of this. But if we take all of that into account and we say they're scoring 0 to 50 on here, I can put a large amount of their entire portfolio in FIAs, because FIAs aren't going to take on a whole lot of risk because they do have that component of, we have a guaranteed floor of 0%, so if the market crashes, you don't lose anything, so that's great. But then the most they can really do is about 50% of the upside potential. And you're going to get those higher par rates on something like the S&P 500 for the longer length of time you go on annuity for the overall surrender period. So this, if there's 5-year, 10-year, 14-year annuity products, the longer you go, the higher par rate you're going to get on all of that. And then also the longer durations for the index. So if it's a 1-year, 2-year, a 3-year, you're going to get your largest par rates on this index. And so going out there, we might be able to get a maximum of close to 50% of the S&P 500 at the time of this recording. Now, all of that to say, all of these pars and caps and the internal indexes used are going to adjust multiple times on a monthly basis. So to track where all of this is at in the future is really hard to do, but I can tell you right now, for the longer term stuff that's out there, 50% par rate is pretty good. So someone that scores with a risk tolerance of 0 to 50, if we put a lot of their assets in this, they're not going to be displeased, because if the market crashes, they don't lose anything, and when the market goes up, they might get that 50% up. Versus now, if you compare this over to an Ed Jones account, a Merrill Lynch, a Morgan Stanley, any one of those brokerage guys, even Wells Fargo brokerage guy, all of these different brokerage companies that put people in mutual funds that are 50%, a diversified blend of equities and cash alternatives, might go 50% of the upside and 50% of the downside. So these FIAs are really a better position for those folks. Now, for the folks that have 51 all the way through 100 on the risk tolerance, these FIAs become less and less appropriate. It's not that they're not appropriate, it's that they become less appropriate. And so here's how to differentiate and say, okay, well, maybe they're a 70, and in their brokerage account they have some funds in there that are 100% pure equities or just a straight up index. Now we can blend it with a large majority of money in an FIA and a super high risk component in their brokerage account. And of course, if they don't have that in their current brokerage account, we might be able to help them set that up so that is a part of their plan, so they can get that extra layer of risk, but also extra layer of gains should it go up enormously, should the market go up a good amount. So we can blend that however we want to too. I've also seen stuff on the super aggressive side of the spectrum where people will take on proprietary indexes in annuities and chase some of those higher rates of return too, while still protecting their downside risk. So you get to choose on what kind of blend that you want to put them in here. So it's not just a conservative, moderate, or aggressive like this sheet might suggest. You get to decide, I can take 50% of their portfolio and make it conservative, and 50% of their portfolio and make it aggressive if they're a moderate risk tolerance here. So I can blend those and say, yes, some of their investments are going to be appropriate in annuities, and some of their investments are going to be appropriate outside of annuities in more aggressive type stuff. Now, that's all to say, we've taken a light at this with the FIA tunnel. In variable annuities, we can take on some larger risks, and in true fixed annuities, so not fixed index, but fixed annuities, they can go even ultra conservative and just give a flat interest rate, or MYGAs, as referred to in the Annuity 101 course. So know that there's this big spectrum, but knowing the risk tolerance and time horizon is going to give us a better perspective. So this is why I usually like doing this at the end of a fact finder, when I know I have the opportunity to come back with some recommendations on the investment side, and then use this in my case design planning. Now, occasionally you won't have the opportunity to do that. You'll already be presenting and realize, I haven't filled one of these guys out yet, and you'll have to do it on the fly, which is much, much harder. So that's why it's so important to do a fact finder and first appointment extremely well and get all of the details and information, versus going back and having a product to pitch but not understanding how the client might think about risk. After you come back and as you're presenting, if you've already filled one of these out, you can make reference to it. You can say in your case design, and you can have recommendations, say, Mr. Client, you're only 40% score in the risk tolerance section. And so based on that, if we put you in an FIA that's getting 40 or 50% of the upside, we're doing really good, because you're not going to take any of that downside. And we can match up those risk tolerance scores to the appropriate products that we're putting them in here. So that's all for risk tolerance. I know this was a short video, but I want to make sure that you understand it is important to fill out after the fact finder, because that'll help us know how can conservative, moderate, or aggressive the client is, and that'll help us in presenting the case and doing the case design work, so that when we actually present this for the client, we've taken this into account, we're making appropriate recommendations for them, and so that they know we're doing the best thing for them based on how they score this. Again, there's a lot of wiggle room in how you do this, so you can score husband and wife totally separately and make them both go through a questionnaire, or if they've got joint accounts, you can decide to take both of their answers and combine them for a middle score number to figure out where they score in this risk aversion. So those are some of the tricks of the trade on this risk tolerance questionnaire. I think that'll be helpful for you to use in your practice. Even if your main line of business is P&C and Medicare, if you found that there's other assets in here and we have the opportunity to take a look at those assets for the client, that's when it's appropriate to fill out this questionnaire. So keep it in your back pocket or keep it along with your normal fact finder. It's not something that you're going to have to fill out on every client, but it is very, very helpful to have for you to be able to do on the fly with the client at the end of a fact finder if you realize that there is an opportunity to work with them on that. So thanks for watching, and I will definitely see you at the top.